How to open a short position using the volume continuation strategy. Here's the playbook we review before entering every trade. If we want to short a market using this strategy, we need to pay attention to following conditions. First is high time frame downtrend. Next is key level also from high time frame. Then low time frame entry candle. This candle needs to contain negative delta and negative delta profile, plus large volume. Altogether, this creates a bearish setup with a very high probability of success. So let's break it down mechanically, step by step. We always start by analyzing the higher time frames, 1 hour, 4 hour or daily. We pay attention to current market condition and decide based on that whether it's more suitable to look for long or short. Once we spot downtrend, we know sellers are in control, so we identify key levels from which the price could potentially bounce. Perfect. Now we move to lower time frame and wait for the right setup. Once the price reaches our key level, on lower time frames we want to see bearish candle with high delta and strong volume. This selling pressure needs to be confirmed, so ideally the price should close below these levels. The further the price closes below these selling volumes, the stronger the acceptance of these volumes is. If the price closes above these levels, it indicates bearish absorption. But if the price closes below these levels, it means that all these sellers have the strength to push price lower. Once the price pulls back to these volumes, all the capital becomes active again and will aim to protect their positions by selling even more. And this is exactly the opportunity for our short position. So, the area of these volumes is where we place our limit sell order. I usually place stop loss just above these volumes because once the buyers manage to reclaim the area above these bearish volumes, our setup loses its validity. For the take profit, I usually target the swing low on the other side or high volume candle that stands in the way of my short position. Because as you already know, high volume acts as a strong barrier, strong zone for the price. So at this point, price may pause, consolidate or even reverse. And that's exactly the reason why I like to take my profits in these zones. Here's a live example how I approach this strategy. The 4-hour time frame is strongly bearish. There's a clear downtrend. The orange box on the chart marks 4-hour key level. The price has reached this key level and start rotating down from it, following the trend. So now I'm just waiting for strong activity combined with a large negative delta on 5-minute chart. Here we can see first sign of activity. There's an increase in volume with a negative delta, which is exactly what I've been waiting for. Now I just need to wait for the price reaction. Will these sellers push the price lower or are they being absorbed? All of that depends on the price, so let's see how the price will react to this activity. When we look at this zone in the detail, we can see very strong level with bearish imbalances and strong negative delta. The plan is simple. If the price moves below this volume and close below it, it's strong indication that sellers have strength to push the price lower. At first, it looked like the price would rotate higher and these sellers would be absorbed. However, once the price returned to this selling area, it pulled back again. So it's clear sign that sellers are in control and the buyers have no strength to close above those sellers. So they are still in control. A few minutes later, another high volume print with a negative delta formed. The candle eventually closed below these high volumes, and this is exactly the situation where we set and confirm our sell limit order. The price closed below all of these high volume areas. And since there's also negative delta, it means the close confirms the seller's strength. We can take advantage of that momentum and open short on pullback to these high volume levels. Since we are in a 4-hour downtrend and also near 4-hour key level that is holding the price, plus we have confirmed seller's strength on the 5-minute time frame, there's very high probability that if the price returns to these volume areas, it will reject them in the direction of the trend. So the entry will be somewhere close to these selling volumes with stop loss placed above them. The take profit in this case is set to 1 to 2 risk reward ratio. Remember that it's good to set your take profit levels at areas that make sense, such as swing low points, or even better, at high volume candles that stand in the way of your position. That's why it's always a good idea to check whether there's enough room for the move before opening a position. If you have large volume below you, it's very risky to take a short position because in about 70% of cases the price will then consolidate. So if you want to have clean, fast trade, you need open space for the movement, what's known as volume void. Volumes are useful when in case of short they are above you, because they act as a barrier for the price, making it harder for the price to move against your position. If the volumes are against your position, it's a problem. Big problem, because the price will struggle to break through these levels, especially if there are newly formed volumes. So this is the way to short using volume momentum strategy.